Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. Well, the market was very volatile on Friday and continues to the start of this week as the US-China trade tensions flared on Friday, sending the Australian dollar to a 5-year low below the 60-cent level, last seen during the COVID-19 pandemic. The sharp drop followed China's announcement of a 34% retaliatory tariff on all US imports, set to take effect Thursday in response to President Trump's new tariff regime. Adding to the market's volatility, a strong US non-farm payrolls report showed 228,000 jobs added in March, beating expectations of 140,000. However, Fed Chairman Powell tempered optimism, noting solid growth but warning of growing risks from Trump's policies, saying the Fed is well positioned to wait on rate moves. Technically, the Australian dollar remains vulnerable after crushing the 60-day simple moving average, which now gives a little direction, and the RSI, MACD and the ADX is indecisive. However, potential demand near current lows could support a rebound towards a level of 61 to around 61.5. If trade tensions ease, that is, although weakness still could push the Australian dollar towards the lows of 59 cents as the tension remains on key inflation data this week, being the US CPI. And also not forgetting the Fed's minutes. Turning to the euro, having reached the 110 level last week, the euro extended and rallied on to the mid 111, which was achieved after Friday's data showed the US non-farm payrolls for March climbing to 228,000 as mentioned earlier. Given the market volatility, a pullback is currently expected towards a region of 108 and reassess from there. But overall, we're locked now in a 108 to a 111.5 range. Technically, though, this could be a brief pullback and the bounce could send the market through 110 to 111. Turning to dollar yen, well, it was all cheers as the decline hit the target of 144.2060, but soon found aggressive demand and sent the market rallying back above 146. We're not out of the danger zone because we're still holding beneath the breach of this trend line, which was a key level around 148, and therefore still have eyes on the downside to 144 and reassess. If we do see a break, then we've got to jump to the weeklies because beneath 144 gives little imagination till 140. Sterling, well, the market's a little bit mixed. It did break the trend, but still holding close to it. I do feel that there is going to be a bit more whipsawedness into the market, so therefore traders should wait for clearer signals before committing to any significant directional bias. So I'm going to be neutral just for the short term and see how this plays out. Wrapping up with commodities, well, it was very whipsawed for gold, as investors took profit amid intensifying global trade tensions and growing recession fears marking the lowest level since March 13. Having hit consecutive record highs last week, gold retreated following US President Trump's tariff announcements. Nevertheless, looking at the technicals, I still feel there could be another move to the downside that could bring in somewhere around 2,750.60 before turning around and then rallying back to around 3,100 to 3,200. After turning my view neutral late last week, the market has plummeted and still remains weak. It looks like there is a little bit more downside to come, and it could actually see the move to around $57 a barrel before turning around and looking for an aggressive rally back towards $60 to $64 a barrel. Well, that's a wrap. Thank you for joining me. And as always, look out for the intraday report, and I hope you enjoyed a great start to the new week.